Hello and good afternoon, everybody. This is Marivic, Hammond, Senior Investment Advisor, and joining me today is Matt King, our Chief Investment Officer. Welcome to the last and final webinar of 2013. Thank you for joining us today. Today we are going to cover the following topics. We are going to talk about 2013, the financial markets in review. Matt and I are also going to outline the bond market preview for 2014, as well as the stock market preview for next year. And lastly, we're going to give some investment tax tips for 2013, followed by a question and answer portion at the end. So to begin, let's take a look at what happened in the U.S. stock market this year. For the stock market, 2013 proved to be a very positive year for investors in terms of return and volatility. Year to date through December 2nd, the S&P 500 index is up 28.6%. Now that represents the best calendar year for the S&P since 2003, even surpassing the return in the first year of the current bull market, which was back in 2009. Additionally, for the second year in a row, volatility has been incredibly mild, which has been a nice reprieve for investors, especially after the highly volatile years of 2010 and 2011. Now, this year, the S&P 500 experienced the least amount of volatility since 2006, and the largest correction that was experienced all year amounted to just about negative 5.8%. Now that occurred between May 21st and June 24th, so the correction was not only shallow in depth, it was also short in terms of its duration. And it is important to note that this mild year with over 20% gains occurred in the face of serious concerns about Fed tapering and all of the drama that occurred in Washington, D.C., including the fiscal cliff at the start of the year. We had the sequester and also the more recent government shutdown and the debt ceiling slowdown. So as they say, Wall Street climbs a wall of worry. What we have here is a summary of returns of 2013 so far for the U.S. equity market. This is broken out by market cap, investment style, and also sector type. Now, starting at the top with market cap, there has been very little difference in performance this year by company size. Now, while small caps did the best, the margin between these as well as large and mid caps was very small. The same can be said with investment style in the middle of the page. As you can see here, the difference in returns between value and growth stocks was negligible this year. And the same thing can also be said with sector type. As a whole, there was a very little difference in performance between cyclical and non-cyclical sectors this year. So what this tells us is that 2013 was a very broad-based upmarket for U.S. stocks. It also speaks to the lack of meaningful trends within the U.S. market, as nearly everything performed similarly, although that's certainly a good thing with returns like these. To find the trends within the U.S. stock market, you only had to dig a little bit deeper. While cyclical and non-cyclical sectors perform similarly as a whole, you can see some performance differentials once you review each sector individually. So essentially 8 out of the 10 sectors had a really good year, up at least 17%. However, it proved to be just 2 sectors that were the outliers last year, or this year rather. And those are utilities and telecommunications, which were only up in single digits. If you were able to avoid or underweight those, you likely had a very good year with your U.S. stock allocation. But again, it just goes to show how few distinct trends there were within the U.S. stock market this year. Yet, as noted, that's not necessarily a bad thing when you have returns like this. So that was our U.S. equity scorecard. Matt, I'm going to turn it over to you now, and if you can walk us through how the foreign markets did.
Yes, thank you, Marivic. So the foreign markets had a similarly good year in 2013 when it came to returns, but the ride really wasn't quite as smooth as it was for U.S. investors. It was range bound for most of the first half of the year, and we really didn't see a strong uptrend in foreign stocks until the second half. Now, year to date, the MSCI EAFE index, which is the benchmark index for foreign stock markets, is up 20.6% through December 2nd on Monday. That represents the best calendar year for the MSCI EAFE index since 2009, which was the first year of this current bull market. And after a few years of above average volatility for foreign stocks, given everything that was going on in Europe, this year the MSCI EAFE experienced the least amount of volatility since 2007, which was the final year of the previous bull market. Now, while the EAFE went through a bigger mid-year dip than the S&P 500, the largest correction that was experienced all year amounted to just minus 10.2%, which in the grand scheme of things is a relatively normal and average size correction. And that occurred between May 21st and June 24th, so the correction was just as short in duration as the S&P 500's was. Given the early year weakness in foreign stocks, at least relative to what the S&P 500 was doing at the time, you can see just how strong they've come on in the second half of 2013 when you plot a chart like this one that measures the performance of the MSCI EAFE and the S&P 500 index since June 30th. You can see the MSCI EAFE in red and the S&P 500 in orange. While foreign stocks trail domestic stocks for the year, the recent momentum definitely resides with investments outside the United States, and that will be an important consideration as we form our projection for 2014, which we'll get to in a bit. While trends were difficult to find within the United States, as Marivic pointed out, they were relatively easy to find when you searched globally by geography. The United States, Europe, and Japan were the best places to be, as their stock markets all posted gains of at least 20%. Without exception, emerging markets were not the place to be in 2013. The best performing of all the major emerging stock markets was China, with an 8.32% gain. Meanwhile, South Africa, Latin America, Russia, and India all lost money. And that was a tough thing to do in the equity market this year. Now, theoretically, you would expect emerging markets to do well in a risk-on environment like 2013 has been. But that clearly was not the case, which is why it's important to invest based upon what the market is doing and not what you think it should be doing. Another negative trend we witnessed this year was natural resource-based economies like Canada, Australia, and Brazil. These economies and stock markets have been chugging along for years on the back of large-scale natural resource purchases from China. However, those purchases began to slow earlier this year, as have these countries' exports. As a result, their stock markets, which are heavy in natural resource companies, suffered. Moving on to the bond market, things were unusually exciting for fixed income investors this year. In the spring, interest rates started to rise quickly. Ultimately, the 10-year Treasury yield, which is the benchmark yield for the entire bond market, rose from 1.63% on May 2nd to 2.98% on September 5th. And because bond prices move inversely to interest rates, this caused the bond market to correct by about 5% over those 4 months. Now, while bonds have recovered much of that loss, they are still down for the year, minus 1.89% year to date through December 2nd. If they end up finishing this year at a loss, this will be the first year in which the bond market has lost money since 1999. With rising interest rates, 2013 was not a kind environment to bonds. With the exception of high-yield corporate bonds, virtually every other bond type has lost money so far this year. It's not surprising that high yields were the one bond type that excelled in 2013, as they are more closely correlated to stocks than to bonds. While high-yield bonds had a good year, we don't suggest chasing that return by exchanging some of your lower-risk bonds for them. Because they are more closely correlated to stocks, they can endure significant losses when things don't go well. Low risk bonds, despite the losses on the year, still have a role in your portfolio as a diversifier and a risk reducer. With that, let's take a look forward at what we expect the bond market to be like in 2014. We have to start by looking at the direction of interest rates. So let's go back to that chart of the 10-year Treasury yield that we showed a couple of slides ago. Again, it's important to focus on the 10-year Treasury yield because that is the benchmark for the entire bond market. While the speed at which rates rose from May to September took us and much of the bond market by surprise, we never felt the need to get defensive as we expected the 3% level to act as a ceiling on rates. If rates had continued to move through that level, we felt that the Fed would have come in with language to calm the markets and prevent further rise in interest rates. Otherwise, if rates kept increasing, it would threaten the Fed's current easy money policy that they are employing to bring the unemployment rate down. And that is exactly what ended up happening. The Fed went on a campaign to reassure investors that they had no intention of tightening rates, and the 10-year subsequently retreated. We see it as unlikely that the 10-year yield will decline precipitously back below 2% where it was earlier this year, but it does appear that rates have stabilized in between the 2.5% and 3% range, as you can see on the yellow box on the screen. The Fed has made it clear that they don't intend to hike interest rates until the unemployment picture is resolved with a jobless rate that is at a maximum of 6.5%. However, the improvement in the unemployment rate has stalled in the low to mid 7% range, and it will take more than just a few months to bridge that gap, barring a significant pickup in economic activity. And with President Obama nominating Janet Yellen as Ben Bernanke's successor, we have another Fed chairman who thinks along the same lines as Bernanke, that the Federal Reserve should play a large role in stimulating the economy and supporting the job market. So this likely translates into a zero interest rate policy for years to come, and we are highly certain that we won't see a rate hike by the Fed in 2014. Given that we're projecting a stable interest rate environment for all of 2014, you may be asking, what about that dreaded taper? Before I answer that, and it's a valid question, let me explain what the taper refers to in case you don't know. The Fed is currently buying $85 billion per month in treasuries and mortgage-backed securities. The taper refers to a reduction or cessation of those purchases. The bond market is concerned that reducing or ending these purchases will result in higher rates. In May, when Bernanke first mentioned that the Fed might taper in September, that is what caused the spike in interest rates we saw earlier this year. Ultimately, the Fed did not taper at its September meeting, largely because of the dysfunction in Washington, D.C. that was about to occur. They wanted to make sure that was resolved without issue before removing stimulus from the financial markets. That makes it seem unlikely that the Fed would taper at their next meeting at the end of this month in December, with another potential government shutdown and debt ceiling showdown set to happen in early 2014. We believe that the Fed will begin to taper their open market purchases in 2014. However, we see the earliest point that would happen as being their March meeting, when the next round of political dysfunction is hopefully resolved. And here's one of our most important points for you today, and something you should take into 2014 in terms of your bond allocation. When the Fed does taper sometime in 2014, it will not cause interest rates to spike. And the reason we don't see the slowing or the cessation of the Fed's bond buying program to cause interest rates to spike is because the Fed has shown no ability to influence long-term rates with their purchases. The Fed implemented their bond buying program in 2 stages, 3 months apart. First, buying $40 billion a month in mortgage-backed securities beginning in September 2012, then buying an additional $45 billion a month in longer-dated treasuries in December 2012. And as you can see on this chart, rates were actually falling prior to the Fed's first announcement announcement of open market bond purchases in September 2012. By the time they announced the additional purchases in December 2012, rates were starting an uptrend. And since the advent of this bond buying program, the interest rate on the 10-year Treasury is now over 1% higher. So if rates have been increasing ever since the buying began, why are they set to spike when the buying slows or stops? Clearly, the Fed does not have influence over longer-term rates, and they've come to that conclusion too, which is why in 2014 they'll be shifting away from bond purchases, which haven't been effective, towards forward guidance. And what we mean by forward guidance is that the Fed will actively and clearly communicate to the market their intentions for raising short-term rates, which is something they do control directly. When rates spiked in the spring, the bond market made the wrong assumption that tapering meant the Fed would be ending their open market bond purchases and raising short-term rates at the same time. As soon as Bernanke made it clear they were not the same thing and that short-term rates weren't going anywhere, the bond market calmed down and the 10-year started to retreat from the 3% level. So rather than continuing with ineffective bond purchases in 2014, the Fed will continue with the forward guidance and reassurance that short-term rates aren't going anywhere for a while, which has shown some effectiveness in keeping long-term rates contained. Because the yield of long-term bonds are linked to the yield of short-term bonds, there is a limit on how high long-term rates will go if short-term rates are stuck near zero. On the screen, you'll see a chart of the spread between the 10-year Treasury yield and the federal funds rate, which is the rate that the Fed controls. The largest that spread has ever been is 3.85%. So if the Fed funds rate stays near zero, which the Fed says it will, the highest history suggests the 10-year will rise is about 1% from current levels. Therefore, we view the chances of an extended uptrend in interest rate as highly unlikely as long as the Fed keeps short-term rates near zero, and that's something we feel very confident they'll do through all of 2014. So despite the significant run-up in rates between May and September, the fixed income markets can be characterized by a steady yield trend between 2.5% and 3% for 2014. We feel comfortable maintaining our duration in the 5-year range to pick up some yield by focusing solely on intermediate term funds because of our outlook for a stable rate environment for all of next year. We also think it makes sense to pick up yield by extending credit risk a bit by over-allocating towards corporates, mortgage-backed securities, asset-backed securities, and high-yield bonds. We also continue to view muni bonds as a solid option for investors in any of the top 3 federal tax brackets. So that now that we've gone through our projections for the bond market in 2014, Marivic, can you tell us what we expect from the stock market?
Certainly. So for the 2014 stock market preview, here's what we are going to look at, and we're going to look at it from 3 different perspectives. First, we'll take a look at what the current fundamentals say about the future stock performance. Then we will show you that what our momentum-based indicators say about the best places to be invested in the stock market. And lastly, we'll take a look at what history suggests about the type of year 2014 may turn out to be for stocks. So when we look at the current fundamentals in the equity market and the 3 components of equity returns, which are earnings growth, dividend, and valuation multiple expansion or compression, or in PE, we see factors that point to slightly higher stock prices for next year. Now, in terms of earnings growth, analysts are projecting a 10% increase in earnings per share for the S&P 500 in 2014. We actually think that is way too optimistic, as we're already seeing sales and earnings top out and growth decelerate at around 0%. So additionally, profit margins are also at an all-time high, so they are not likely to expand. And stock repurchases, which has helped EPS in recent years by reducing shares outstanding, are starting to slow. So now when you put all of these together, we don't see how a 10% increase in earnings growth is achievable, barring some huge and sudden pickup, of course, in the economy. So currently we have our earnings growth projection at 4% for the US stock market. As it stands now, dividends would add about 2% to the 2014 return on stocks, but there is a good reason to expect that more of a contribution as companies continue to increase dividends. Now, of the 336 dividend policy changes in the S&P so far this year, 324 of those represented increases in dividends or initiations of a dividend payment. And companies are still sitting on significant amounts of cash. So we feel that the trend of dividend increases is likely to continue in 2014. However, the data also clearly shows that companies are spending about twice as much on share repurchases rather than dividends, and this is an effort to maximize their earnings per share. As for valuations, stocks in the US are trading at about 20% above their long-term average. We could see PE multiples expand as a result of increased risk-taking by investors as they chase strong gains in the stock market. In fact, we're already seeing a significant amount of investment flows moving from bond funds to stock funds. Now, however, with a market that's already 20% overvalued, you don't want to count on further multiple expansions. So even without any PE multiple expansion, earnings growth plus dividends suggests that there will be a positive years for stocks in the 6% range. There are two main threats to that projection, and those are a pullback in earnings, which we view as unlikely, or a PE multiple compression due to the declines in investor confidence. That is more likely scenario, given that the overvalued conditions of the US stock market right now. So you can see that those would be the biggest risk going into a positive year for stocks in 2014. So while fundamentals in the US point to an okay year for domestic stocks, the picture overseas appears much different, especially in Europe and also in Japan. Now, Europe is coming out of a recession, so it is where the US was a few years ago. As the economic situation there improves, so should earnings. Japan has thrown a massive amount of stimulus at its economy. The yen has depreciated versus the US by about 25%. And by 30% relative to the euro. This will prove highly beneficial to the bottom lines of Japanese exporters. So while double-digit earnings growth seems like a stretch for US economies in 2014, it actually seems likely in Europe and Japan. Plus, when we look at dividend yields, those are about 50% higher than here in the US. So while that's all positive for foreign stocks, that's not the best story. Now, if you take a look at the chart that we have on the screen, this breaks down the MSCI EAFE's total return since 1995 into three components that we have been discussing, and those are dividends, earnings per share growth, and multiple expansion. As you can see, while the EAFE has nearly tripled since 1995, it's been all dividends and earnings. Not only has the PE multiple not contributed anything to return, it actually has detracted from return by negative 42.3%. And as you can see, a lot of the PE contraction has been in recent years as investors worried about Japan's seemingly permanent economic stagnation and the possibility of a Eurozone breakup. So given that the prospects for both Europe and Japan have improved significantly over the past year, we see a very good chance that the PE multiple actually increases in 2014 and starts to contribute to return. Now, if that happens, we could see very strong gains in the European and Japanese equity markets from a combination of dividends, earnings, and PE multiple expansion. Now, based on our current readings of our momentum indicators, which should have some legs into 2014, we see the following as the best places to be invested in the stock market. Now, of course, momentum may change during the course of the year, which is why we don't recommend simply buying and holding these areas of the market, but rather taking an active approach that responds to changing market conditions. So in terms of geography, the United States has the best performance momentum in the world right now. But as we showed earlier, developed Europe and Japan have been closing that gap since July. While we already have moved some of our clients' money to these foreign regions, we expect that we will likely do more of that next year. We expect earnings growth to be more robust overseas, and the stocks are about 20% cheaper than here in the US. So it is more likely that we will see some degree of multiple expansion that could add significantly to returns. In terms of market cap, it varies by region. In Europe and in the US, it makes sense to invest across the board among large, mid, and small caps. In Japan, however, our focus is solely on large caps, as the bigger exporters should benefit the most from a depreciating yen. When it comes to investment style, we don't see any distinction in terms of momentum right now, so we will maintain exposure to both growth and value. As for sectors, the ones that appear to have the best momentum heading into next year are healthcare, including biotech, consumer discretionary stocks, industrials, and broker-dealers. Now, we've taken a position in U.S. broker-dealers like Charles Schwab and Morgan Stanley. It's interesting to note that broker-dealers are benefiting from increased investor confidence as more investors move back into the stock market. More confidence means more trading and, of course, more commissions. Also, broker-dealers are benefiting from the prospect of higher interest rates. Now, one of the major sources of profitability of these firms is their money market funds. However, the near zero interest rates have cut into that profitability over the last few years. So with the possibility of higher interest rates, the market is expecting this profit center to return for broker-dealers. So despite what you read, rising interest rates aren't necessarily bad for everyone. In fact, you may want to consider broker-dealer stocks to be a bit of a hedge against rising interest rates, as their money market business will clearly benefit from this event. So in looking at historical trends as they relate to the calendar and the stock market, let's take a look at what a presidential term cycle says about stock market returns in 2014. In looking at the performance of the Dow historically during each term year, you can see that year 2 is the worst year of the presidential cycle when looking at average returns, which registers at a price gain of just 3.75%. Now, price return doesn't factor in the dividend, so when you add that, which is currently 2.2 on the Dow, you get about 6% expected return for 2014. Now, interestingly, and for whatever it's worth, that is exactly the same projected return we came up with for the S&P 500 using the more fundamental approach. So for those of you who have followed our webinars and writings this year, you know that we have maintained throughout that we are still in a secular bull market that began in March 9, 2009. This despite 2 severe corrections that we've experienced in 2010 and also in 2011. With that being understood, it's worth looking that we are in the current bull. It's worth looking what we are right now in terms of the bull market from a historical context. So in looking at the graph or at the chart, the median bull market between 1900 and 2007 gained 82.5% before dividends, and that lasted about 2.6 years. Now, this current bull market has seen price gains of 166.2%, and that's lasted 4.7 years. So at this point, you can say that the bull market is getting a little long on the tooth in terms of gains and duration. However, bull markets can go on as much longer than this current one, especially when there is very accommodative monetary policy. For us, this is just another further evidence that we'll see a shift away from U.S. stocks towards foreign stocks in 2014. And while the S&P 500 is at an all-time high, the MSCI EV index still sits at 23% below its all-time high, giving us a lot more room to run. So at this point, I want to shift gears a little bit and let me turn it back to you, Matt, and maybe perhaps you can give us some year-end tax tips.
Absolutely, thank you. So you still have a few weeks to make some moves that could potentially reduce your 2013 tax bill, and we just have some ideas to go over with you here. If you have a taxable investment account, it may make sense to harvest some capital losses prior to the year's end, and this involves selling securities that are currently in the red to generate capital losses to offset capital gains realized earlier in the year. However, it's only worth doing if you need those losses to offset gains. If you have capital loss carry forwards from previous years or other deductions that you can use to offset your gains, there's really no need to harvest losses because you'd be selling securities that you otherwise might not want to sell at this time. And given that, as Marivic pointed out, we're into almost year 5 of the current bull market, it may be a bit challenging to actually find securities in your portfolio that are still below their purchase price. If you do have losses you can harvest, you do need to be aware of the wash rule. If you sell an investment at a loss and then repurchase those shares or shares of a quote-unquote substantially identical investment within 30 days prior to or 30 days after the sale, you won't be able to use the loss this year. It's especially important to be aware of this rule now that brokers are reporting your cost basis to the IRS. Along with reporting your cost basis, they're also required to report if you violate the wash rule with any of your sales. And because we're in the holiday season, which is traditionally the season of giving, you may be considering making a charitable donation to your favorite organization or cause. If that is the case, you should strongly consider making that donation in shares of an appreciated investment rather than in cash. With cash, you only get to write off the value of the donation. With appreciated shares, not only do you get to write off the market value of the security at the time of donation, but you also get to rid your tax liability on those shares. So it's really a 2-for-1 tax saving special. The catch is that you must donate shares that have unrealized gain and that have been held for at least 1 year and 1 day. If you donate shares that are at a loss, it actually works against you, as you can lose your ability to write off that capital loss. And if you donate shares held for 1 year or less, you can only write off your cost basis rather than the current market value. Beginning back in 2010, anyone, regardless of income, was allowed to convert their traditional IRA to a Roth IRA. And this involves moving money from a traditional IRA to a Roth IRA after paying ordinary income taxes on the conversion amount. The benefit is that once the money is in a Roth IRA, it's never taxed again. So since the removal of the income limits in 2010, we've performed many analyses for clients wondering if a Roth IRA conversion makes sense for them. More often than not, the answer has been no, as our typical client is close to retirement age and in the upper tax brackets. Because of the tax owed on the conversion up front, a conversion is typically more beneficial to younger investors or to those in lower tax brackets. However, given that the tax year is wrapping up, it's worth checking with your tax advisor to see if you have any tax credits, exemptions, deductions, or ordinary losses, not capital losses, that may go unused this year due to insufficient income. If you do, you can use them up by doing a Roth conversion and getting the money from your traditional IRA, where it will be taxed as ordinary income upon distribution, to a Roth IRA, where it will never be taxed again for potentially very little to no tax cost. Of all the tips we mentioned today, Roth conversions are far and away the most complex, and when we do them for clients, we do it in conjunction with their tax advisor. So you should definitely consult both your investment advisor and your tax advisor before proceeding. But it's important to get moving soon, as the deadline for conversions is the same deadline for harvesting losses and making charitable contributions. That's December 31st. So that concludes the presentation portion of today's webinar. A recorded version of today's webinar will be available on our website within a week. And additionally, all of our past webinars are there as well. Although only clients, we should mention, can access our quarterly investment committee updates. Next month, please join us for our first webinar of 2014 on Wednesday, January 22nd at 2 p.m. Pacific time. to hear our presentation on our firm's philosophy, making a good life happen.
Thank you, Matt. I think we have a few minutes for questions. We do have a couple or three that come in. Before we read those, we just want to remind everybody again that if you wish to submit a question, please type it into the question box on your GoToMeeting control panel. Now, we will answer as many questions as we can, but if we don't get to your question specifically, we will be sure to get back to you with an answer. I have one that just came in, Matt, and let me turn this to you. The question is, what is your outlook for commodities in 2014?
Not good. Commodities are among the lowest ranked in our momentum rankings right now. And the problem with commodities is that you had a huge amount of investment in new natural resource capacity at the end of the last commodities boom, which ended in mid-2008. Of course, when you have projects of that magnitude, it takes years for those to come online, and they finally have been over the last couple of years. So you have a huge supply glut and a lot of overcapacity right now in the commodity space. On the demand side, China has slowed its natural resource purchases, which has hurt as well. And we don't see either the supply or demand picture improving in 2014. So we would definitely underweight or stay away completely from commodities.
Thank you. Here's another one for you. Now, you mentioned that the current bull market has gained 165% and lasted almost 5 years, which is above average relative to history. So for a point of comparison, what is the biggest gain a bull market has ever produced and the longest one that has ever lasted?
So the bull markets in the 1920s from 21 to 29, and the one in the 90s from 91 to 99, each lasted about 8 years. And that bull market in the 1920s, that was the one that produced the largest gain of all time. It was up nearly 500%. So obviously, as Marivic said, this bull market's getting a little bit long in the tooth, but as you can see, bull markets can last much longer and advance much higher than the current one has. One question that just came in, would you please review and explain again the broker-dealer section? Sure thing. So broker-dealers are an area of the market that we're overweighting right now that have improved significantly in recent months due to two factors. One is that really over this last 6 months, you've really started to see money come back into the stock market. You've seen trading volumes increase. So that improves their business in terms of volume and commissions. So that's one positive. The second positive is that people don't realize how profitable money markets are under normal circumstances for broker-dealers like Schwab or Fidelity or Vanguard. When interest rates are normal and people are parking massive amounts of cash in money markets, they're hugely profitable because they can charge a nice expense ratio on it, and they're very low cost to run. The problem is with interest rates being near zero over the last few years, they basically had to waive most or all of their fees on money markets just so that they didn't pay a negative return, which, obviously no one would use a money market if that was the case. So as interest rates rise, and we still think that's a few years out, but the market is anticipating that as short-term rates rise eventually, that this profit center, the money market funds, are going to return for broker-dealers as money pours back into money market funds, and it'll help their bottom line significantly.
Thanks, Matt. And I think there's just one more question that I will answer. With the market being in risk-on mode in 2013, why did emerging markets underperform? So the reason is the same reason that commodities also underperform. China slowed its natural resource purchases, and a lot of these emerging market economies like Brazil, for example, Russia, and South Africa, they're natural resource based. The Asian emerging market economies are not, but they are also highly dependent on selling goods to China. So investors are fearful that China's economy will continue to slow down and affect the purchases of goods from the rest of Asia. I think that's all the questions that have come in. Thanks again, everyone, for participating today. Of course, you don't need to wait for our monthly webinars or letters to stay in touch. We do update our website with new content on a regular basis, and we also post our daily market updates on Twitter. Our Twitter handle is BellInvest. We also have a finance blog in which we discuss investment and financial planning topics. You can find that at financialadvisorblog.bellinvest.com. And lastly, please don't forget to check out Bonnie Bell's Career Life Coaching blog, which you can find at careerlifecoaching.bellinvest.com. As always, if you have any questions specifically about your portfolio, do not hesitate to email us or give us a call on the phone. Lastly, our webinar today, the presentation slides are available to you if you request. And we want to wish everyone the best of 2014. Happy holidays to you and yours, and thank you again for participating today. Goodbye.